Hello, I'm Anthony Saglin-Benny, Chief Market Strategist at Ameriprise Financial. The 2024 U.S. presidential election cycle has been an eventful one, to say the least. And with all the notable recent developments and political uncertainty, it's natural to feel anxious and have questions about how changes in Washington may financially impact your life. To help you make sense of how the outcome may affect the broader market, economy, and investments, I have a great panel of experts with me to share their insights and analysis. However, before I turn the conversation over to them, I'd like to preface our discussion by saying that, in general, presidential election outcomes have a limited effect on the long term performance of the broader market. And regardless of who occupies the White House, investors are generally well served by maintaining a well diversified portfolio and staying the course with their investment strategy. Further, I'd like to emphasize that this discussion is intended to provide perspectives on how potential election outcomes may impact financial markets, the economy, and investments. These insights are not political statements from Ameriprise Financial, nor are they an endorsement of a particular candidate or political party. With all that said, I'd like to introduce Liz Varley, Senior Vice President of Government Affairs at Ameriprise, and Russell Price, Chief Economist at Ameriprise. Thank you both for joining me. Liz, I'd like to start with you. Could you share an overview of the key policy items you're watching that may impact investors and how this shakeup in the Democratic presidential ticket has changed things from a policy perspective, if at all?
Thanks, Anthony. Well, tax changes are on the table in 2025. Both presidential candidates have highlighted tax as part of their economic platforms. For his part, former President Trump has proposed to exempt taxes on tips and to lower the corporate rate from 21% to 15%. Vice President Harris has proposed enhanced child tax credits and incentives for home buyers. But at the same time, she's also proposing new higher taxes for wealthy individuals, those making more than $400,000 a year. She's proposing to tax gains at death, and she's also proposing an increase in the corporate rate. Former President Trump has proposed a 10% across the board tariff on all imports coming into the United States, and he's proposed an additional tariff for imports coming from China. Vice President Harris has said that she opposes an across the board tariff. From a policy perspective, has the race really changed that much since Vice President Harris became the Democratic nominee? I would say the outlook is fairly similar. She was President Biden's running mate and has held the vice presidency with him for the last 4 years, and she's chosen to align herself with his policy proposals. So even with all the twists and turns, we're back to the race that we thought we would have, which is a very close race at the presidential level and likely continued close margins in Congress.
Liz, just a follow up question for you. It doesn't really get as much attention as the presidential election. How do you see the makeup of Congress affecting some of the policies you mentioned? And what's the likelihood we'll see divided government as the outcome of this election?
From a tax perspective, the control of Congress is very important. Presidents can make big picture statements about the direction of tax policy, but the details are usually left to the House and Senate to work out. The House of Representatives and Senate, if it's controlled by Democrats, I think we can expect to see higher taxes and less tinkering with some of those clean energy credits that were enacted as part of the Inflation Reduction Act. On the other hand, if Republicans maintain control of the House and pick up the Senate, and many people expect that the Senate will be at least 50-50 with the potential for Republicans to take control of the Senate, then I think we would see that the core of the Tax Cuts and Jobs Act, which was very much a base broadening exercise, will stay in place. But there are going to have to be some changes on the revenue side out of concerns about growing deficits. Tariffs are a very different story. Tariffs can be initiated through the executive branch. And we saw that happen with former President Trump when he was in office, and President Biden chose to continue many of those tariffs. So if former President Trump does win, I think we can anticipate another attempt to do some tariffs. while he is in office. Vice President Harris has said that she does not support across the board tariffs. So it remains to be seen what she would do with those tariffs that were continued by President Biden.
Yeah, as you were talking, Liz, I mean, it was making me think about historically how markets respond to divided government. They generally respond well. You don't see a lot of changes in tax code or fiscal policy when Congress is divided. However, in these periods where you do see a little bit more shift or one party gaining control or the other, some of the policies that you mentioned are things investors need to pay attention to. I would say historically, most of the time, Congress is divided, so it limits the changes to the rules of the road that we see. And usually markets look past the elections because these changes, even when we have one party control, seem to be very slim. And it helps with keeping the rules of the road not changing too much. Russ, I want to bring you into the conversation and kind of get your perspective around the economy. What impacts can presidents have on the U.S. economy, and what are some of the key issues that you're watching in this election cycle?
Well, Anthony, first let me say we don't expect the election, the pending election itself, to have any impact on the underlying economy. We may see some anxiety or some volatility in financial markets or such, but the underlying economy, with no changes between now and the end of the year in tax policy or spending policy, we don't expect economic activity to vary much from what has been its recent pace. With that said, I should note that we are in a period of the economy moderating its pace to some degree, including when it comes to job growth and consumer spending. In the first half of this year, the economy grew at a real rate of about 2.25%, and we forecast in the second half of the year a rate of about 2 to 2.25%. So a little bit softer pace, but still a pace that should be solid enough to maintain the current course that we're on. Looking beyond the election, as you and Liz already discussed, any president has three levers that they can pull to really have a tangible impact on the underlying economy, and that is taxes, spending, and the degree of business regulation. Certainly, as you discussed, the president would need the participation of a friendly makeup in Congress to get their policies through. So at this time, that remains a pretty big question mark as to what we might see after the election. So with that, we expect to see at least in the early part of 2025, the economy remaining fairly sound.
Yeah, great perspectives, Russ. I know a question we get a lot from clients is just about the size of the national debt and the deficits that we're running. Do you see, at least from the terms of debt, are we nearing a tipping point where that becomes a larger issue? What do investors need to know about this issue, particularly as it pertains to our national debt?
Sure. The debt and deficit situation is very concerning. We're very close to debt as a percentage of the underlying economy, that is debt to GDP, reaching just about 100%. That benchmark, however, really doesn't have an impact on the underlying circumstances, but we are certainly on an adverse trajectory. The Congressional Budget Office currently projects that what we spend simply on interest expense for the federal debt will more than double by 2050 through the end of their 30-year projection period. Right now, interest expense captures about 20% of federal tax revenues. In other words, of all of the taxes that are paid into the federal government, 20% of that right off the bat goes towards paying the interest expense. Prior to the pandemic, that figure was approximately 10%. And as I said, by 2050, we could go to about 35%. So, and the debt limit is currently on suspension. But that suspension goes away in January 2025, right after the election. And so, over the first half of 2025, there will be quite a robust discussion between both sides of the political aisle as to raising the debt limit once again. The Treasury Department will implement extraordinary measures, but those will probably take us through to probably May at the latest. So, Anthony, let me turn the questions back to you on the market side of the equation. I know that you mentioned that election outcomes have a limited effect on longer term market performance. So, what's the relationship between the market and presidential elections? And how can investors prepare, if at all, for the period leading up to Election Day?
Great question. Russ, you're right. I mean, the markets generally look through elections because other factors impact stock prices more. So, to your point, the level of growth in the economy, the level of growth in corporate profits, the level of interest rates, these are the factors that drive stock prices longer term. But during election years, you do typically see volatility rise 60 days before an election. And that's because investors are trying to figure out what's the shape of the White House going to look like, what's the shape of Congress, what does that mean for policy and taxes and regulations, some of the things that we talked about on this call today. And so that's an uncertainty leading up to the election. But once those results are known and investors can start anticipating those rules of the road that we talked about earlier, they typically then that volatility declines, and you typically see stocks start to focus more on those fundamental factors. One of the things that may linger after this election is what Liz talked about: taxes and tax code. What is that going to look like? And that's likely going to be an uncertainty into 2025. But potentially lower interest rates, a growing economy, these are some of the other factors that may have just as much or more impact on stock prices as we move through next year. I would say in terms of taxes, we've seen lots of changes to the tax code and tax adjustments over time. Markets have historically moved higher. It's simply because taxes are just one element of the factors that move stock prices over time. So in our view, investors are well served by maintaining a well-diversified portfolio, looking through the political noise, which is likely to intensify over the coming weeks, and recognizing fundamental conditions in the U.S. markets and the economy sit on a solid foundation today. That's likely to be the case following the election and into next year, no matter who wins the White House. With that said, thank you to my colleagues Russ and Liz for joining this conversation, and thank you to our clients and other viewers for watching. If you have any concerns about the impact of the upcoming presidential election on your financial life, contact your Ameriprise financial advisor. They're here to help you navigate the political uncertainty and help keep you on track to your financial goals. Thank you.